Yeah. Yeah, you don't do that. It's just it's not interesting when speakers are going hard. Like I just want to see more speakers are like no. Like basically a huge and use
Just down the corridor. No, it's somebody the person next to me has a large office and he wanted to stay in a large office. We have three largest offices, one of the large three. And he said, so they asked me whether I'd be willing to give up my larger office for a smaller office. Okay, folks. Okay, just a very couple of quick reminders in case you need them. The first is we have 10 days left in the class, right? So everything's going to come at you in a rush. So the nagging will continue and will not stop till May 5th. So I'll keep reminding you of things to do. If you've done your DCF and you're on your way to pricing, you're pretty close to done. So at this point, it's just pulling together. I'll send you some details about the final exam tomorrow and kind of the logistics of that. But expect emails from now through May 5th pretty much every day, perhaps twice a day. So today we're going to continue our discussion of real options. And rather than put you on the start of the class test, which is what I usually do, I'm going to frame the start of the class question. Let's say I have the rights to a non-viable technology. You know what do you mean by non-viable, right? Today, if I try to develop it, the cost of developing it exceeds what I will get as cash flows. And let's give this non-viable technology a frame of reference. It's an AI technology. It'll speed up the processing of data, make it less expensive. But right now, it's not viable. I own the rights to this technology. If you're Apple or Microsoft or Google, might you be willing to pay a price for that non-viable technology? Ahan, why? In other words, when I compute the viability, I look at the cash flows from developing it today, the cost of developing it today, and all I'm saying is today the cash flows are less than the cost. I wouldn't develop it. But 2 years from now, when I look at it, who knows, right? The cash flows could be different, the cost could be different. So you're buying it not because you're being unrealistic and you expect to develop the technology today, but because you think this technology could become viable. But it rests on me having exclusive rights. If I didn't have exclusive rights, you'd be crazy to buy it, right? But if I have exclusive rights, let's build on this theme. That value you're willing to attach to this non-viable technology, will it get greater or smaller if I have more years of exclusive rights? Go ahead, William. It should increase, right? If I give you 15 years of exclusive life, it should be worth more than 10 years. And now comes the magic. What will happen to the value of this technology as you feel more uncertain about the business that this technology is in? Ahan? It goes up. And that's where everything we've talked about so far seems to be turned on its head, right? I mean, think of what I just told you. The more uncertain you feel about the future, the more you're willing to pay for non-viable technology. Why is that? Because the price you pay is your maximum downside, and the more uncertainty there is, the greater the potential for upside. That's at the heart of the real options argument. So before we look at real options, let's do some mopping up because we still have to get the option pricing part. In last session, I talked about what it is that makes an option an option. It's a payoff diagram. That unique payoff diagram where you have limited losses, potentially unlimited profits. Second stop, question I'm going to ask is, when does an option have significant economic value? I'm going to put out a word here that I want you to remember in the context of any real options discussion that to me separates valuable options from those that are not valuable. The word is exclusivity. If you and only you can have the rights to that option is worth a lot more than if a lot of people have that same right. So let's take example. Jake, what's his name? Jake, right? You wouldn't look up, so I wasn't sure whether I got your name right. Oh, okay, no. So you're taking it down. So Jake, do you rent your apartment right now?
No, I live.
You live at home. That's tough to reframe. Anybody renting their apartment? Oh, you rent your apartment? Let's suppose I'm your landlord. I'm not, but I'm not, so I'm your landlord. And I give you the right to buy the apartment you're renting anytime over the next year. How much would you pay for that right? Forgot to ask me something very critical. William, what is the right to, what did I give him the right to buy his apartment, right? What did I not mention? Claire? I didn't mention a price. Without a price, the right to buy something is worthless, right? Because the right to buy at the prevailing market price is worth nothing. There's no exclusivity. But if I said, I'll give you the right to buy your apartment at $500,000, there is an option. As long as I don't go around offering homeless people on the street the same right, right? It comes from that exclusivity that comes from the price. So when you're looking at options, you're saying, is there exclusivity? And to the degree that there's exclusivity, there will be a lot of value. And to the degree that the exclusivity gets weaker, it's not 0-1, the value of the option is going to slip away. So when you look at a real option, in addition to the payoff diagram, you're asking the question about exclusivity. Let's now look at, if there's exclusivity, what is it that drives the value of an option? There are only 6 variables that determine the value of an option. There's no debate to have about it. Here are the 6 variables. 3 relate to the underlying asset. The first is the value of the underlying asset. As that goes up and down, the value of all options on that asset will go up and down, right? With a call option, you get the right to buy at a fixed price. So the underlying asset becomes more valuable. The call option is going to become more valuable. The second is the variance in that value. And here's where the magic of options kicks in. The greater the variance in that value, the underlying asset, the more valuable all options, calls as well as puts, become on that underlying asset, that limited loss feature. And the third, and this is sometimes forgotten, is any dividends you expect to get on the underlying asset will affect the value of your option. Think of why. Let's say you have a traditional call option on a stock. And tomorrow is supposed to be an ex-dividend day. You know what an ex-dividend day is? That's the date in which ownership of the dividend passes from one person to another. So you buy before the ex-dividend day, you get the dividend. You get it after, you don't. So tomorrow is the next dividend day, and it's going to be a big dividend, $5 dividend per share. What's going to happen tomorrow to the stock price, Tyler? It'll drop roughly $5. Maybe not quite because of tax differences, $4.93. Why does it affect you? What do you have as a call option? The right to buy at a fixed price, right? Every time a company pays a dividend, the call option becomes less valuable because the price goes down and put options become more valuable. Those are the 3 variables relating to the underlying asset. There are 2 relating to the option itself. One is the strike price of the option. The right to buy at a lower price is worth more than the right to buy at a higher price. So call options become more valuable as the strike price decreases and put options become less valuable. And the longer I give you in terms of time, the more valuable all options become. There's only one macro variable that affects option pricing, which is what the riskless rate is. You're saying, why would I care? What do you get with the call option? The right to buy at a fixed price at the expiration date, which might be a year, 2 years, 3 years from now, right? As interest rates rise, the present value of what you have to pay becomes lower. Call options become more valuable. The right to buy something at $50 3 years from now, that $50 becomes a much lower number if interest rates are 15%. So as interest rates go up, call options become more valuable, put options become less valuable. Every option pricing model, you're going to see those 6 ingredients come into play. So We can see what makes for an option, the payoff diagram. We see what drives the value of an option is exclusivity. Let's talk a little bit about option pricing models. You've seen these in your foundations class, at least, kind of. Don't worry, I'm not going to probe you on specifics. Kind of. No. You might have seen the Black-Scholes model. You don't remember it, I know, but you have seen it, right? I'm going to step back and talk a little bit about the two building blocks that all option pricing models are built on. The first is this notion of replication. What does that mean? That you can create something that looks exactly like the option in terms of cash flows by combining the underlying asset and either borrowing or lending. So we'll talk about what that combination is, but you're going to create a replicating portfolio. And if that replicating portfolio has the same cash flows as the option, you draw on a second principle. It's called arbitrage. What is the arbitrage principle? If two things have the same cash flows, they should be priced exactly the same. I know it's abstract, but the simplest way to see replication at play is to actually look at this replicating portfolio that delivers the same cash flows. So if you have a call option, there's a combination of borrowing money and buying a certain number of units of shares in the company that will give you the same cash flows as a call option. With a put option, selling short the stock and lending that money out will give you the same cash flows as a put option. The entire focus on option pricing is to come up with that replicating portfolio. I'm going to show you the Black-Scholes model in a couple of minutes, but the best way to see replication is with what's called a binomial model. Binomial model is a very simple model. The stock price at any point in time can go to only one of two points. So if the stock price is 50, in a binomial model at t equal to 1, the stock can either go to 70 or 35. If it goes to 70 at t equal to 1, in the following time period, it can either go to 100 or 50. If it goes to 35, it can jump back to 50 or drop to 25. At t equal to 2, the second time period, the stock can end up at 100, at 50, or at 25. Let's say you have a call option on this stock with a strike price of 40. Two-time period expiration, so it's going to expire at t equal to 2. Jake, help me out here. If you have a call option with a strike price of 40, how much will you collect as cash flows if the stock goes to 100? What will you do? You get $60. You exercise at 40, you sell it at 100, you keep 60. If it goes to 50, if it goes to 25, why not minus 15? Because it's your choice, right? The stock goes to 25. You say, why would I be crazy to go out and buy shares at 40 when I can buy it at 25? So it's zero. The cash flows in the option. My job in replication is to create a portfolio that has exactly the same cash flows as the call option. And what are my two things that I play with? The underlying asset, the shares of stock, and borrowing or lending. So let's set up an algebra problem. Let's say you have delta shares of stock and B in borrowing. You think this is not an algebra class? Hang in there. It's not going to be that complicated. Stock goes to 70. What do I need to do? I need to borrow B dollars and buy delta shares of stock, and that position has to generate cash flows of 60 if the stock goes to 100 and 10 if it goes to 50. Agree? Because that's the cash flow in the call. I don't know which grade in school you did simultaneous equations. Somewhere, 7th grade, 8th grade. If you have two equations and two unknowns, sooner or later, neither should be unknown, right? You play with it and you kind of, that's basically what I'm doing. I'm solving two simultaneous equations and I end up with D equal to 3604 and D equal to 1. He's saying, what does it even mean? If the stock goes to 70 and I go out and borrow $36.04 and buy one share of stock, I will have a position that has exactly the same cash flows as the call. How much will it cost me, my money, to create that position? I'm borrowing 3604. That's not my money. I'm paying 70. That difference of 3396 is what I would have to spend to create the replicating portfolio. Arbitrage now kicks in. If it has the same cash flows as the call option, the call has to trade for 3396 if the stock goes to 70. So I know the value of the call. The stock goes to 70. I repeat the process if the stock goes to 35. There, the cash flows have to be 10 if the stock goes to 50, 0 if it goes to 0. I solve for delta and B. Borrowing $9.01 and buying 0.4 shares of stock. Don't even ask me how you buy 0.4 shares. Let's say you can. Will deliver exactly the same cash flows as the call. That would cost me $4.99. That becomes the value of the call if the stock goes to 35. You always have to start with the last branch and work backwards because that's the only branch where you know the cash flows in the option. Now I value the option. Stock price is 70 and a stock price is 35. I go back to today. I'm at 50. Again, I repeat the process. How many shares of stock do I need to buy? How much do I need to borrow? You solve for that equation. Borrowing $21.61 today and buying 0.8278 shares of stock will give me a position that has exactly the same value as a call all the way through this life. That position would have cost me $19.42. That becomes the value of the call option. The binomial tree, you can see the replication arbitrage work itself back. The only problem with the binomial tree is you can jump to only one of 2 points in the next time period, which means your time periods have to be really, really short, right? Because if I make it a day, think of all the possible prices that a Facebook or a Google can go to. But if I make time 1 minute, maybe I have a shot. Let's say I do that. Every time period is 1 minute, and I have a 3-month option. You ready? I want you to draw a binomial tree of 1 minute time periods for 3 months. Can you visualize it? It's going to be first you have to have a magnifying glass and a really sharp pencil. You draw a little branch and a tiny little branch. Let's say you do this. When you're done, it's going to be this really dense tree, right? Hang in there with me. I'm going to flip the tree over on its base. What does it look like? It looks like a Christmas tree without a trunk, right? Then I smooth out the outsides of the tree. Think of a Christmas tree with smoothed out sides. What does it start to look like? A normal distribution. If as time gets shorter, my price changes also become smaller, the binomial model becomes the Black-Scholes model. The binomial tree becomes a normal distribution. The Black-Scholes model is a special case of the binomial model if price changes get small as time periods become small. Now, in the Black-Scholes world, the way a stock goes from 35 to 50, it goes 35, 35.01, 35.02. That's a continuous. It never jumps. It's kind of a strange assumption in the real world, but it gets you this advantage of a normal distribution and all of the pluses that a normal distribution gets. Could prices jump in short periods, especially after a month like this one? The answer is of course, right? In the real world, prices can jump. There are versions of the option pricing model that have been developed for jump processes. One is called the Poisson process. I don't know whether you remember from it, where you can have a price jump. They've never acquired traction because getting the inputs of those models is incredibly messy. So I'm going to give you a very quick intro to the Black-Scholes model in case you don't remember. The Black-Scholes model, the value of a call option is a function of 5 variables. S, which is the current value of the underlying asset, K, which is the strike price, T, which is the life of the option, R, which is the riskless rate. For some reason, Microsoft Word on a PC converts my sigmas from a Mac into a box, but that's sigma squared. That's a variance. 5, but didn't we mention 6 variables that drive the value of an option? What's the missing one? SK, which is no. Claire? I missed the dividends. And I'll give you the story as to why dividends are not part of the original Black-Scholes. Fisher, Black, and Scholes taught at the University of Chicago. 1971, they were working on this process. And in fact, their breakthrough was recognized because until 1971, people valued options. They treated it as if it were a standalone asset. They took the expected cash flows, tried to come up with a risk-adjusted discount rate. And Fisher, Black, and Scholes said, that doesn't make any sense. It's a derivative asset. We should be able to value it by creating this replicating portfolio, which looks exactly like it, and then figuring out how much it'll cost. So they started writing the paper, and they got 2/3 through the paper, and they got stuck. They got stuck on this equation where to take a derivative, but it's normally we think about calculus, but traditional calculus wouldn't work. It requires something called stochastic calculus that nobody in finance had ever used. Legend has it, they were stuck for weeks, maybe even months, until a physics PhD student was walking by, came into their office uninvited, looked at the equations, and we see this all the time in physics. we used this Ito's lemma. And they said, what's Ito's lemma? And he took them through this very basic process. That broke open the process, and they came up with the Black-Scholes model. Fisher, Black, and Martin Scholes won a Nobel Prize. I don't think the nameless PhD student in physics got any Nobel Prizes for doing it, but he unlocked the equation. But they were stuck. And they were stuck to the point where they said, we're going to remove dividends. This is the classic economist problem to dealing with the problem. Let's assume it away. The original Black-Scholes was designed to value either non-dividend paying stocks, options are non-pay, or dividend protected options. You're saying, what's a dividend protected option? Remember, what drives the value of the options is when you have a dividend, the stock price drops by $5 or $3 or $1. If you have a dividend protected option, the exercise price is also lowered when the stock price drops. There isn't a single dividend protected option that's actually traded in the world, but in their model, they said, let's ignore dividends. And if you carry that model through, you've got the Black-Scholes model. The way I describe the Black-Scholes model is it'll make you touch all those keys in your calculator that I call virgin keys. Keys you've never touched before. That exponential key, the heck is that? That LN, big LOG, you say, I've never touched those keys, right? This is just, basically, when you look at the Black-Scholes model, you see E minus RT, you can say natural log. But let's take a step back, because embedded in this model is that replicating portfolio we got in the binomial model. First, there's S. S is the value of the stock or the underlying asset today. It's not some expected value. Then there's N D1. You're saying, what the heck is that? Well, to get to N of D1, first I need a D1. And there's this elaborate equation. By itself, there's no intuitive grasp to that. It's all the inputs that drive an option pricing model go into D1. Once you get D1, you go into a normal distribution, and N of D1 is the area under the distribution to the left of D1. See, what does that even tell me? N of D can go from 0 to 1. It's like a probability. So N of D1 and N of D2 are roughly speaking probabilities. In fact, N of D2 in particular has a very explicit meaning. It's a risk-neutral probability that your option will end up in the money. You know what in the money is, right? S is greater than K. So if N of D2 is 0.8, there's an 80% chance your option will be exercised. Let me go back to the previous page. This N of D1 is also called the option delta. Remember how in the Black-Scholes I solved for the number of shares of stock you need to buy? That's in the Black-Scholes. The N of D1 is the number of shares of the underlying stock that you will have to buy to replicate the option. KE minus RT is just the present value of the strike price. Why present value? Because Black-Scholes models were designed to value European options. European options can be exercised only at expiration. And because it can be exercised only at expiration, you don't pay the strike price till 3 months from now, 6 months from now, 2 years from now. It's the present value factor. KE minus RT times N of D2 becomes the borrowing. Embedded in the Black-Scholes model is the same replicating portfolio you saw in the binomial. You just saved yourself a lot of time by not having to do the branches and assuming a normal distribution. So that's the original Black-Scholes. As you can see, it was designed to value dividend protected options. Unfortunately, with real options, which is going to be our topic, we will have something like dividends in almost every option. So I'm going to give you a version of the Black-Scholes that you're going to see me use more today and on Monday to value options. In this model, I'm actually going to allow my underlying stock to pay a dividend. Let's think through how this will play out. Remember the replicating portfolio? You went out and borrowed money and bought the underlying stock. When you borrowed the money, you had to pay a riskless rate. You had to borrow the money, so it's an interest rate. But if your stock pays a dividend, what can you do with the dividend? You can use the dividend to pay some of the interest due, right? If you take the difference between R and Y, the risk-free rate and the dividend yield, you're getting a carrying cost. So if the risk-free rate is 5% and your dividend yield is 3%, you need to come up with only 2% to cover the cash flow. So that's the first change. The second is every time a dividend gets paid, what happens to the stock price? It drops a little. So what you will see is to the stock price, I add an extra factor, which is every dividend yield is effectively a drop in the stock price. If you have a 3% dividend yield, I'm knocking your stock price down by 3% ahead of the fact, saying there will be a dividend, it reduces my S. This is the dividend adjusted version of the Black-Scholes, and this is the model you're going to see as we go through this class in terms of applying on real options. Incidentally, that dividend yield in real options is going to take on an intuitive role. And effectively, here's why we need it. The traditional options, you buy an option. Let's say you buy it on the right kind of stock. The stock goes up. It's a listed option. You will never exercise the option. Why? Traditional, you go to the CBOE, you buy an option, buy the right kind of option. Why would you never exercise the option before its exercise date? Because you can sell it. When you sell it, you get the option, the exercise value plus a time premium. So because of time premiums and options, 95% of options on the CBOE get exercised at the last moment of the very last day of their lives. You're saying, what about the other 5%? The other 5% get exercised just before an ex-dividend day. And here's why. What do you say happens on the ex-dividend day? The stock price drops, right? So we have a call option and tomorrow is going to be a really big ex-dividend day. Sometimes what you will lose by waiting the day exceeds what you will lose in terms of time premiums to exercise early. We're going to use real options to value patents, to value natural resource reserves. Let's say you have a patent for the next 17 years, and I value it as an option, and I don't have a dividend yield or the equivalent. What am I going to do? I'm going to wait 16 years and 364 days, and on the very last day, I'm going to start to develop the patent, which makes no sense at all, right? I've lost all the protection I could get. What the dividend yield or the equivalent does in real options, it introduces the cost of waiting. I'm going to trigger you to exercise early. With real options, exercising early should be more the rule than the exception, because that's how you make money. So in my model, whenever you see dividend yields from this point on, think of it as a cost of waiting. And sometimes that cost of waiting will be large enough that you choose not to wait and exercise early. You develop your reserves, you convert your patent into a product, and that's effectively how you end up making money. Couple of final points. The Black-Scholes model, as I said, was designed for European options. Most real options get exercised early. Sophia?
What do you understand the dividend as a cost of waiting? Because in options, like you own stock and pays high dividend.
But remember, you have the call option on the, you don't own the stock. You have a call option on the stock, right? Because you have a call option, until you exercise, you can't collect the dividend. Exactly. That's why it's a cost of waiting. So if you wait and you hold on to the option, you never get the shares. You don't get the shares, you don't get to collect the dividend. That's why it's effectively the cost of waiting. The Black-Scholes model was designed to value European options. European options can be exercised only at expiration. And as I said, real options tend to get exercised early. There are a lot of real options purists who will argue you should never use the Black-Scholes model to value real options. You should use a binomial model. Technically, they're right, but I've tried drawing binomial models for real options. It's an incredible pain in the neck. All these little branches, hundreds of branches. You know what? I'm going to continue to use the Black-Scholes model to value real options even though they get exercised early. And here's my defense. When you use the Black-Scholes model to value an American option, remember American options can be exercised anytime before exercise, you'll get a lower bound on the value because effectively you're removing the exercise rights. So I might underestimate your value in a real option. I'm okay with that. So even though the Black-Scholes was designed to value European options, I'm going to value American options using it and say that's a lower bound. If you want to add a premium on top of that, because you can exercise early, go ahead. But I'm not going to give up on the model because the binomial is just too intractable, too difficult to work with. Last point, and then we will kind of dig into real options. Guys familiar with decision trees? What do you do in a decision tree? First, what kinds of risks are decision trees best suited to deal with? Discrete and sequential, right? So we used it for failure risk, but if you have discrete and sequential risk, a decision tree is a great way to capture the risk. See, that's abstract. What kind of businesses have discrete sequential risks? Take a pharmaceutical company, right? What's a discrete risk? First, you got 3 stages to the FDA approval process. At each stage, you can get approved, not approved. If you don't get approved, the game ends. If you get approved, then you follow to the next stage. We have discrete risks that are, in a sense, on top of each other. A decision tree works. So this is what a decision tree will look like. Don't let it intimidate you. This is a diabetes drug that effectively you're trying to value today at the start of the process, and essentially takes you through each sequence. Stage 1, stage 2, stage 3, and in each sequence, what's happening? You either succeed or fail, and if you succeed, you're getting information about what to do in the next sequence. You can actually take this decision tree, and it's called rolling it back, and effectively start with the end nodes and work it back one stage at a time, and you can get an expected value. You will get exactly the same value as you would get using an option pricing model. Now, this morning I had somebody in my MBA class who's going to work for Novartis, a pharmaceutical company. He's very caught up in option pricing because it looks like something he could use. And I said, why don't you try decision trees first? Because it's actually much more intuitive. Most people can relate to decision trees. You bring out the Black-Scholes model. It's like bringing a bazooka launcher out to kill an ant, right? And it's just too much to do. So sometimes it's better not to bring the option pricing out when you can use traditional probabilities and statistics and decision trees to capture what you want to do. Your question? No? So here's what we're going to do. Right? We're going to take a bunch of real options. With each one, I'm going to start by introducing the option with a payoff diagram. Say, this is why there's an option. Second stop, I'm going to talk about where the exclusivity comes for that particular option. And third, I'm going to try an option pricing model, sometimes with basis, sometimes kind of stretching the definition to value the option. Okay? So I'll go back to the start of the session on Monday when I talked about how in traditional capital budgeting, you take the cash flows, you take the discount rate, and you come up with the present value, and you come up with an NPV. And when you do that, you miss 3 big options. So first is the option to delay. Now, if you have the exclusive rights of the project, it might not look good today, but it could look good in the future. The second is the option to expand, where if this project gives you information, you might be able to do a second project, especially in a big market of immense value. And the third is the option to abandon. So what I'd like to talk about is examples of options to delay that have real relevance. And some of you are working with companies where I think the option to delay kicks in. And then we'll talk about the option to expand and the option to abandon. The option to delay comes from the fact that you have exclusive rights to a project. Let's say right now the project is not viable. The net present value is negative. The right basically means that this project could become valuable in the future. So this is the starting question for today. So if I were to draw the payoff diagram of the option to delay, here's what it would look like. You can take the project at any time during the 10 years you have the rights to do it. That becomes the equivalent of the strike price. The underlying asset becomes the project you will take. So the present value of those cash flows become like the S in the model. If the present value of cash flows exceeds what you will need to invest, you will take the project, keep the difference. If that never happens, the right expires worthless. Be familiar with how patents work in the US? Somebody, Tyler, so what is it? How does a patent work?
I think we could try to do something.
And who gives you this right? The US government, basically, right? You have to file with the patent office. If they approve the right, you get the rights for the next 70, the next 20 years. And you have exclusive rights to whatever you've patented. In the US, you can patent all kinds of stuff. Sometimes you look at things patented. Is it really? You can patent that the way you package a box can be patented. You get exclusive rights. During that period, you and only you can develop this patent. You see the structure here for an option? Let's say you have a patent, okay? You have the right to develop the patent. Let's say it costs you I. I can be I, 100 million, 500, that becomes the equivalent of the strike price. Would you develop the patent? Depends on what you think the cash flows from developing the patent are. If that present value of the cash flows is V, you will develop the patent if the present value of the cash flows exceeds the cost of developing the patent. If that doesn't happen, there's no guarantee it will. Doesn't, what happens then? At the end of the period, you throw the patent in the trash can. Say, I wish I hadn't spent the money acquiring that patent. You ready for the payoff diagram? The cost of converting the patent into a product becomes the equivalent of the strike price. You will develop the patent only if the present value of the cash flows from developing it exceeds that cost. But if that never happens, you lose what you paid to get the patent. Remind me again how companies end up with patents. What are the two ways in which patents can end up?
You buy a patent.
One is you can buy a patent and let somebody, Sophia, what's the other way?
File your own patent before.
But where did that patent come from, right? By the time you file the patent, somebody must have developed it within. Basically, it'll be the R&D you spend to develop the patent. So that becomes the cost of the option. R&D is really money you're spending to buy options as a pharmaceutical company, as a technology company. There's an option here, right? One of the things I find troublesome with real options books is they talk in the abstract. So I want to make this real. Let's say you want to actually value a patent. Let's see how we'd come up with the inputs you would need to value the patent. Let's start at the top. You need a value for the underlying asset. Remind me again what the underlying asset here is. We have a patent. Sophia? The product that comes out of the patent, and then the S will be the present value of the cash flows if you develop the patent today. Will that require work? Yes, it'll be like a capital budgeting exercise, right? Project revenues, project margins, project cash flows, take the present value, that'll become the S. What's the variance in that value? When you do a present value calculation, you did a DCF, right? You got expected cash flows, you got a discount rate, you got a value. Could that value change tomorrow? Yeah, could change the next moment. Probably change today while you were sitting here. Because everything shifts. The variance in the value basically comes from the fact that that present value compute will change over time. And there are two ways you can estimate that variance. One is you can do a Monte Carlo simulation. Remember we talked about this in the context of valuing companies like oil companies, where you let the oil price vary. In a Monte Carlo simulation, you get a present value, you get a standard deviation of that present. That's a lot of work though. If you're lazy like me, there's a second way you can do this. Let's say your patent is in biotechnology. What if I could give you the standard deviation of stock prices in biotech companies? It's lazy and sloppy, but think of how much time you save and use that as the standard deviation in your present value. So I've got S, I've got sigma, or variance. What's the exercise price? You got to develop the patent. The cost of developing the patent becomes the strike price you will use. What's the life of this option? What's the option here? It's the patent, right? What's the life of the option? It's whatever years you have left on the patent, 15 years, 17 years, 20 years. And finally, when you look at dividend yield, here's what I'm asking. If your patent becomes viable, you might be tempted to wait and collect more information and come up with a better product, which I understand. But is there a cost to waiting here once a patent becomes viable? Jake, what's the cost? It's not just time value. It's protection, right? What does a patent give you? It gives you protection against competition. If you wait, you're giving up some protection. There's a cost to delay. It's messy valuing patents. Why? Because much of the information you need is internal information. It's not something you can observe from the outside. So I'm going to give you an example of a patent I valued, and this is almost 27 years old. And the reason I've stuck with it is this was one of those rare cases where I was able to get my hands on the numbers that a company had. It's a company called Biogen. It's still around, but at that time it was a young biotech company. It had 2 drugs it had already developed that it had licensed out to other pharma companies. We'll come back to those 2 drugs. But the big draw in this company was a drug that had worked its way through the pipeline and had passed through all 3 stages of the approval process called Avonex, the drug to treat MS. And what gave me the advantage here was I was able to get my hands on an internal cash flow analysis that Biogen had done on Avonex. If any of you guys ever get your hands on how pharma companies estimate cash flows in a drug, it's both a scary and a morbid exercise. Here's what they do. They start with the percentage of the population that has MS. They have a pretty good sense of. The percentage of those people who will go to a doctor, and it's not 100%. And the percent of people who go to a doctor who get the right diagnosis, which is not 100% either. And among the percent of people who get the right diagnosis, the percentage of people who can afford to take the drug. So you can start with 8 million people having MS, and by the time you're done, 2 million will be your potential market. Then you set a price for the drug, and what drives that? What you can negotiate with the insurance company and get away with. And you come up with expected revenues, cash flows, and they've done that. And the present value they came up with was about 3,422 million, developing the drug today. The present value. So traditional capital budgeting. They estimate it would cost them 2,875 million to actually develop the drug. Why so much? Because Biogen had never marketed drug on their own. They'd licensed drugs out, so they had to build up an entire sales force, incredibly expensive process, 2.875 billion. If I stopped right there, and this were a capital budgeting exercise, the present value of the cash flows is 3,422 million. The initial investment is 2,875 million. What's that difference going to be? What do I get when I take the present value of the cash flows and subtract out initial investment in capital budgeting? I'm going to get an NPV. In this case, I'm going to get an NPV of 547 million. Put that to the side. That's my DCF value for this drug. But remember, they haven't developed the drug yet. There's 17 years left on the patent. There's a lot of uncertainty about the future. And here I'm going to cheat and use the standard deviation of publicly traded, or the variance of publicly traded biotech companies, because I can't do a simulation. I'm going to make that the variance in my cash flows. So there's a lot of uncertainty about what will happen to that S. And I put in a cost to delay. Why a cost? Is this a viable drug? Net present value is 547 million. Positive, I should be taking the drug, right? So why am I waiting? Because I can learn more about the drug, the side effects. I can make a better drug. So that part of it is pushing me to wait. But if I do wait, I'm going to give up 1 out of those 17 years of protection from competition. That becomes my cost of delay. I'm trying to force the company to develop the drug, because if I don't, they won't develop the drug till the last day of the 17th year. So I plugged the numbers into the Black-Scholes model, and the value that I got for Avenex as an option is $907 million. And there are two things. One is financial and the other is social. Let's see what the financial implication of this is. This drug has an NPV of 547 million, but an option value of 907 million. So if I'm buying the company, that option value should be what drives what I pay for the company. That's the financial implication. But if you have MS, this is really bad news. Why? The option value is 907 million, right? It's not that they will raise the price. They won't develop the drug. If you develop the minute you develop the drug, remember the optionality goes away, right? If I develop the drug, the value drops to 547 million. If I wait and do more research and collect more information, the value is 907 million. So while you with MS are waiting for the drug, I'm working on the drug next year. How about 2 years from now? In fact, to see how long you'd have to wait, I actually computed two numbers. One is the value of the option, so that's the blue line, and the value of developing the drug, the purple line, the traditional present value. There's a crossing point. It happens about 5 years from now. And why do you develop then? Because at that point in time, the value of the option drops below the NPV. So the bad news here is you're going to wait 5 years to develop the drug. You know what actually did happen though? Biogen developed the drug almost instantaneously. Seeing those noble people. You know why they developed the drug? What's keeping me from developing the drug here? I think I have 17 years of protection. I'm willing to give up 1 out of those 17 years, right? What am I missing when I do that, Sophia?
If it's pro medicine or proof of patent, many countries, there's this thing called forced licensing.
That's not in the US though. So they don't worry about that, right? So you can't be forced to do it. But what does a patent give me protection against? It doesn't give me protection against competitors developing their own drugs for MS, right? It gives me protection against somebody using my compound as an MS drug. What if I threw into the mix the fact that Merck and Upjohn were working on their own MS drugs and were within 5 years of developing that drug? What is the change in my model? So if I said you're only 5 years, waiting 1 year, what's my cost of delay going to be? 1/5. If I put 1/5 is my cost today, the value of the option completely implodes. If you're in a comparative pharmaceutical business, the optionality starts to dissipate because exclusivity is starting to slip away, right? The exclusivity came from the option, from the patent, but to the degree that there are other people working on other drugs for the same disease, you're going to develop your drugs much more quickly. I've never been a fan of monopolistic pharmaceutical companies. There's only one pharmaceutical company in the country. God help you, right? They're going to wait a long time to develop drugs because who's going to get in the way? So when you look at options in the patent business, that's a factor. So I value Avonex as a drug. I want to try to value Biogen as a company. When you look at Biogen as or any pharma company, you can value it in 3 slices. First is the drugs that they already have out there that they've developed already. That's traditional cash flows at DCF valuation. The second is drugs like Avonex that they've been approved to produce, but they haven't pulled the trigger yet. They haven't decided whether to develop or not. Those are options. And there's a third slice, which is every pharmaceutical company has an ongoing R&D department, right? How would you value just the R&D department of a pharma company? You're going to get negative cash flows from the spending you do. What do you hope to get as positives?
Cash flow.
Or the patents they might come up with or might not come up with in year 1, year 2, year 3. Could an R&D department be value destroying? Yeah, you spend a lot of money. They don't come up with very many new drugs. It could be value creating, value neutral. You got to make a judgment. In my company, which of those 3 scenarios will kick in? Sophia?
While in the department, wouldn't we to adjust, for example, for person or whatever?
You could.
Very
You might. If it's a key scientist. But remember, when you look at most pharma companies, there is no star scientist. It's a group of scientists. You have a great lab. So much of the value from the R&D department might come from things that, so if you look at Moderna and say, who created mRNA? It's probably a team of people, and Moderna gets to use that mRNA and whatever new drugs come out. But if there's one person who's a big deal here, then you worry about that key person discount that we talked about in the private company valuation.
selling the drug.
Yeah.
17 years. We can talk on for the fact that maybe the company won't last that long because it's a.
It might be, but if you have a blockbuster drug, it's not about the company, right? It's about the drug. So if the drug is producing cash flows, even if the company goes under, you could sell the rest of the drug. That's one of the easier things to get in a liquidation value is what people will pay for the cash flows in the drug. So here's what I'm going to do to finish my Biogen valuation. So I have the Avonex, which is their only big patent I valued as an option. There are 2 existing drugs out there that they'd already produced, but they'd already been approved for, but they licensed out. One was, I think, licensed out to Merck and the other to Upjohn. And they were getting, there are 2 ways you can license a drug out. One is for fixed fees every year, contractually set, and the other is a percentage of revenues. I want you to file the 2A because I'm going to ask you a very specific question about coming up with the value. Biogen was collecting $50 million in licensing fees on these 2 drugs. And they were fixed fees. What do you have to do? You have to compute the present value of $50 million a year, right? What discount rate should I use on that $50 million in cash flows? This could very well be a question on the final, so I want you to think about it. What is the discount rate I would use to discount the $50 million in cash flows from those 2 drugs?
You use the cost of projects that people risk.
You could, but what kind of claim is this? Go ahead, William.
I was gonna say, like, since to replicate this, we need to borrow.
It's a guarantee claim. It's not an equity claim. It's a guaranteed claim, right? The only thing is the guarantors might default, in this case, Merck or Upjohn. So the risk you face is the risk of default in those companies. Sophia?
Plus CDS
The-
defined.
Or the cost of debt for the client, right? Because that's what the cost of debt is. It's a cost. So I actually took the 50 million, discounted back at a pre-tax cost of debt for Merck and Upjohn, the 7%. Why pre-tax? Because the licensing fees were pre-tax. And what I got as a present value was the present value of those existing products. Now, Han, I'm going to come back to you. I could have redesigned this licensing agreement, but instead of getting a fixed fee, I got a percentage of revenues every year. If that's the way the contract is structured, what discount rate should I use on that?
You sort of run a cost of capital.
Whose cost of capital?
Of those firms that are producing.
Okay. So if it's percent, what if it's percentage of net income? What would I use then? We got it, right? So basically, you tell me how your cash flows are structured. What if I had this with the government instead of Upjohn and Merck? What would I discount? And this were a guaranteed contract. What did I use as my discount rate then? Risk-free rate. Discount rate, so don't get trapped into cost of equity. I know you've learned all this stuff about cost of equity and capital. You feel the urge to pull out betas and risk premiums. Don't do it if I've given you a guaranteed cash flow, because that's a very different set of cash flows. So in this case, the present value of 50 million a year for 12 years, because that's how long the license ran, at the pre-tax cost of debt of the guarantors, not of Biogen, gave me 397 million. And then I got to the R&D department, and I'm going to do some hand waving. I have no idea what Biogen's R&D department will do in the future, but I do have a sense of their history, right? And over the 10 years Biogen had been around, they'd been pretty successful. They turned out 3 pretty big blockbuster drugs, and I think they can continue to do this. So to value my continuing R&D, here's what I'm going to start with. I'm first going to estimate how much money Biogen will spend on R&D every year for the next 10 years. So let's put a 20% growth rate on R&D expenses. That's how much they're going to spend. And now comes the leap of faith. They're going to spend 150 million next year, 120 million next year in R&D. The question is, how much value will that 120 million create? Based on Biogen's history and looking at what biotech companies earn as return on capital over and above the cost of capital, they generally earn excess returns. I assume that $1 invested in R&D at Biogen would create $1.25. Saying, how do you know? I don't. That's my estimate. I am assuming that Biogen's R&D department will continue to create value for the next 10 years. What happens after year 10? I think it's going to become, it's not like the R&D will go away, but it'll become more of a neutral R&D. It'll create $1 in value for $1 spent. So for the next 10 years, I'm going to have excess cash flows over and above what I need to make. And I take the present value of those excess cash flows. So there's my R&D cost multiplied by 1.25 gives me the cash flow for the value that I will get in year 1. The difference is the value created. And in the last column, I take the present value of that value created every year for the next 10 years. What I get by adding up those numbers is about 318 million. That is the value of continuing R&D at Biogen. Let's do a few what ifs. What if $1 in value, $1 in money spent in R&D creates $1 in value? The excess value will go to 0. The R&D becomes a non-factor. Could it be that you could invest for every dollar you spend in R&D, you get only 80 cents back in value? In which case, what is R&D doing? It's making your company less valuable. I talked a little bit about, remember we talked about Merck when I talked about Amgen, it's a few sessions ago, how over the last 15 years, Merck has spent tens of billions of dollars in R&D and has very little to show for it. I'm convinced that at Merck, the R&D added on is actually reducing the value of the company. Put simply, if they shut their R&D department down, send everybody home, their stock price would jump 20%. It's a very perverse way of thinking about R&D. If you're not creating value, that's how it's going to play out. So in the case of Biogen, you add the 3 numbers up, the total value you get is 1.622 billion. Value of the 2 products they've already licensed, value of Avonex as an option, and the value of the continuing R&D. And a few of you are valuing young pharma companies or biotech companies for this project. Using a traditional DCF, right? Where in a traditional DCF of Biogen would I be able to reflect this view about R&D and Avonex? One is through the growth, right? I would say, look, Biogen is going to have high revenue growth because there's this drug waiting in the pipeline, Avonex, that's going to come in. What's the second? margins, right? High margins because you have the protection for the next 17 years. You're going to be able to earn higher margins. And when it comes to reinvestment, I'll have a low reinvestment. Why? Because I've already spent the money on R&D to get the drugs. If you do that, don't add the value of Avanex as an option on top of your DCF. Why not? Be double counting, right? You can't. So if you do a traditional DCF, be careful about adding the value of an entire option on top because that would be double counting something you've already counted in. So let's pass the patent through the three tests I said. Is there an option in a patent? Absolutely. The underlying asset is the drug that comes out of the patent. The contingency is the present value of the cash flows from the drug exceeds the cost of developing, you'll develop it. If not, you won't. So it passes the option test. Is there exclusivity? Technically, yes, right? Where does the exclusivity come from? The US government stands behind your right to develop the drug. But it's limited exclusivity to the extent that there's competition and other people can develop their comparative drugs, and there the exclusivity starts to fade. And third, I'm using an option pricing model to value this option. Option pricing models require replication and arbitrage. You're saying, what does it even mean? Replication requires that I be able to trade the option, trade the underlying asset, and borrow and lend money at the riskless rate. Take out the third requirement. Can I trade this option? Can I go to Bloomberg and check what the price of Avanex? No, the patent is not traded. I can't trade the patent. I can't trade the drug, obviously. This is as far as you get from being able to meet the requirements for option pricing. Doesn't mean I can't use an option pricing model, but it's tough to monetize it. So there is an option, there is exclusivity, but it gets very shaky on the pricing part because it's much tougher to get those inputs. So that's the first real option patent. You can see it applies, but you can see why people don't actually try to price the option. They'll talk about it and they can talk about its value, but they often leave it as it's worth a lot. I'm going to take a second example of the option to delay. Say you're an oil company. Your value comes from two places. One is reserves you've already developed, where you do what? You get the oil out of the ground, you sell the oil, you get the cash flows, you take the present value. Traditional DCF, right? But every oil company also has undeveloped reserves. Let's play out why it's an option. You have undeveloped reserves. You have the option to develop those reserves. Let's see what drives that option. There's a cost to developing the reserves, right? You've got to put up the rigs and expensive process. And there's value of oil under the ground. If the value of the oil under the ground exceeds the cost of developing the reserves, it's an in-the-money option. You develop it, you keep the difference. If that doesn't happen, the reserves will expire worthless. It's like a call option. In fact, if I draw the payoff diagram, here's what it looks like. The cost of developing the reserve becomes equivalent to the strike price. The value of oil under the ground becomes like a stock price. The value of the oil in the ground exceeds that cost of development. You develop the reserves, keep the difference. And if that never happens, you lose whatever you paid to get these reserves. Remind me again how you get reserves. Claire, how do you get reserves as an oil company? She's my oil expert, so she don't. Reserves in general, how do oil companies end up with reserves? One is they acquire reserves or acquire other oil companies. The other is they do exploration and hope they explorate, like the equivalent of R&D, hoping to find reserves. You paid for those reserves. If they end up worthless, you end up losing. So that becomes the price of the option. And here I think we have an advantage in being able to get the inputs. And to see why, let's go through each of the inputs. First, to value an undeveloped reserve, I've got to get an estimate of the value of the oil under the ground. How do oil companies know? I mean, they have all these reserves and they have a value. How do they know how many barrels of oil there are under the ground? This geologist goes and taps on rocks, and lots of oil here, not so much oil here. And before we dump on them, let's face it, they're much better than equity research analysts in their estimates, so let's go with that. So 100 million barrels of oil, and you multiply it by the oil price, you take out the cash flow. So that is the value you'd get if you develop the reserves today. That becomes the S in the model. What's the K? It's a cost of developing those reserves. Do oil companies have a pretty good sense of what it would cost them to develop reserves? It's going to be very different in the Gulf of Mexico as opposed to Canada. It's going to be very different in Canada as opposed to Saudi Arabia. Saudi Arabia, it's, oil's very close to the ground. Your cost of development might be low. In Canada, it's 5,000 feet under the ground and frozen. You got to dig your way down, unfreeze it, pain in the neck, and much bigger cost. That becomes the K in the model. What will it cost to develop these reserves? How many years do you have to do this? Usually, if you get the reserves in an auction, you don't get them forever. The US government auctions off reserves. It's 12 years, 15 years, at the end of which it goes back to the government. That becomes the life of the option. What's the uncertainty you feel about the value? If you're an oil company, you know the reserve. It's the oil price can do. Of course, the reserve amounts can change, but geologists don't change their mind from 100 million to 10 million to 1,000. It's basically the oil price that's a big uncertainty. And here we have an advantage. Do we know what the variance in oil prices is, or is there a place to observe it? There's a market out there. I've been tracking Brent crude all month. Why? Just because I feel like it. It's in that table with the equity risk premiums. I've been tracking everything else. You can go look it up every moment of every day. And that's an advantage. I can look, unlike with a pattern where I had to do a simulation or play these games about where to get, here I can observe the variance. And to complete the process, I do need to introduce a cost of delay here. Do you see why? You have undeveloped reserves that become viable. What do I want you to do? Develop the reserves and get the oil out of the ground. And if I don't put a prod in, you will never develop these reserves. You let them go into the very last day of the last year that you have the rights and try to get all the oil out of the ground in one day. You can't do that. And my cost of delay here is if your reserves become viable and you choose not to develop it, you give up the cash flows you could have got by developing the reserves. So that becomes like a dividend yield, cost of delay. And there's one final aspect of natural resource reserves that you have to incorporate. Let's say oil prices go to $120 a barrel tomorrow. And ExxonMobil decides it's going to develop all its undeveloped reserves tomorrow. So some guy in ExxonMobil headquarters picks up the phone. They're still old-fashioned there. They call everybody in the world at one go, saying, develop the reserves right away. Does the oil start to come out of the ground the next day? Takes a while, right? Might take 2 years. You're saying, so what? What could happen during those 2 years? The first, the 120 can become 60. And the second, there is a time value of money there, right? You now have to. That's going to reduce the value of my option. I've got to bring it in. Sophia?
Is there a way to account for the way that sometimes you may need to prioritize options? For example, if you have a lot of reserves, but your midstream, like ability to
refine there's a limit to how much oil you can get out of the ground. So if you develop reserves, it's not like all the oil comes out of the ground. It might have to come out over 15 years because the rest of your capacity is. The way to bring it in is when you do the present value, you build in the expected cash flows each year with these constraints built in. But often you can lock in the forward price of oil if you choose to as an oil company, right? Because there is a forward market out there. You're not at the mercy of the oil price changing year to year. So you want to lock it in, you can do it. There's a downside to doing that because the oil then goes up, you lose that upside. So, but if you wanted to lock in the cash flows, you can. But you can bring in the constraints through those expected cash flows every year. So let's talk about the inputs that you would need. And I'm going to use a company to illustrate this process from way back in time. 1984, an oil company called Gulf Oil was targeting an acquisition, partly because it had huge undeveloped reserves, 3,038 million barrels of oil under the ground. And the estimate then was to develop these reserves would cost about $10 a barrel. So collectively, $30.38 billion to develop the reserves. At that time, the oil price was $22.38 per barrel. And the variable cost of extracting the oil out was about $7 a barrel. So each barrel of oil, you're making $15.38. So you have 3,038 million barrels of oil. $15.38 per barrel. They had 12 years left on their reserves. That's a period over which they could exercise this right. The T-bond rate then was 9%. Very different point in time in US market history. And one final point, there was a development lag of about 2 years in developing the reserves. And if they did develop the reserves, their cash flows would be about 5% of the value of the reserves. That's what they would give up if they decided not to develop the reserves. I'm going to try to value these undeveloped reserves as options. What's the first step? I take the 3,038 million barrels of oil, assume I can extract the oil and sell it at today's price, net of the variable cost, it's $15.38 per barrel. Of course, I lose those 2 years that I can't develop. That development lag, I bring that in. I get $42.38 billion as the value of the oil under the ground. My development cost is $30.38 billion. If I take the difference, $12 billion, that's my discounted cash flow valuation for these reserves. But let's finish the process. These are reserves that are undeveloped. They haven't developed them yet. There's optionality. I bring in the life, 12 years, the variance in oil price, which I can observe to be 0.03. I put in the cost of delay, 5% each year, and I value the option. And what I get as a value for the option is $13.3 billion. Let me pause right there. My DCF value for these reserves is $12 billion. Where's the extra $1.3 billion value magically coming from? Where's that premium coming from? Or what did have to happen for that premium to disappear? And if I took the oil out of the ground, it's 12 billion. I'm paying an extra 1.3 billion because oil prices are volatile. If oil prices became guaranteed, fixed, that premium would disappear. The value of the option comes from the fact that oil prices are $22.38 now, but they could go to 40 or 50 or 60. This is the premium created by the optionality, by the fact that I can choose when to exercise the option. That's what makes real options so attractive to people, is you add a premium onto your DCF value effectively when you do that. So that's the value of my undeveloped reserves, 13.3 billion. And if I wanted to complete my Gulf oil valuation, here's all I need to do. Take the oil that they're already developing and treat it as a traditional discounted cash flow valuation. They're getting about $915 million in cash flows every year. They expect to get these cash flows for the next 10 years. I apply a cost of capital. So traditional DCF valuation, I get a valuation of about 5.07 billion for the developed reserves. The 13.3 billion for the undeveloped reserves gets added on. The sum of those two values becomes the equivalent of what you'd have gotten at DCF by discounting cash flows back at the cost of capital for the entire company. If I'd been valuing this oil company in a traditional DCF, the way I would have brought in the fact that they have a lot of undeveloped reserves is given them a higher growth rate, less reinvestment. And again, make your choice. You either can work through the DCF and miss the optionality, which is okay. But the one thing you can't do is do a DCF and add the 13.3 billion to your DCF, because then you'll be double counting those same undeveloped reserves. So with commodity companies, you can value the company in pieces as developed and undeveloped reserves. And that's something that will factor into how an oil company's stock price reacts to what's happening in the market. Option to delay, let's talk about the option to expand. The option to expand is truly one of the most scary things we've invented in finance, because it gives you an excuse to do really stupid things and get away with it. And here's why it's dangerous. The option to expand is built around two projects that are bound together at the hip. You got to take the first project to do the second project. And the first project is a negative net present value project. Already you're getting a little wary, right, Nick? But here's what the negative net present value project gives you the rights to: an even more negative net present value project in the future, if you choose to take it. This sounds like it's going from bad to worse, right? But here's what makes that second project palatable. It's a really big negative net present value project today, but it could change in the future. Are companies investing a lot in AI right now? Do you think if you did a capital budgeting analysis of what Meta is investing in AI or Microsoft's investing in AI, that the net present value would be positive? I don't think so. So why are they doing it? Because if AI turns out to be as big a market as we think it is, they're hoping that this initial investment will give them the option to expand into that market. And they're therefore overlooking the net present value being negative on the first investment because they get an option to expand that's worth a lot. I know it sounds abstract, but if I did a payoff diagram, here's what it would look like. The additional investment you'll have to make to expand into that big market, if it does show up, will become the equivalent of the strike price. Would you expand? You would expand only if the present value of the cash flows from expansion exceed the cost of expansion. And is it possible that that never happens? And if that never happens, then what have you lost? The first investment I said is a negative net present value. Just write it off. That 10 billion you spent, write it off. And the bigger the market is, the more the attraction of the option to expand. I'm going to argue that this was the basis for many US companies investing in China 20 years ago. It's a big market. We're going to make money. Investing in India right now, investing in AI, investing in .com in the 90s. Big market, option to expand. You're willing to overlook the fact that you're overspending now because you think the option to expand you get is going to be so valuable. So I'm going to give you a very simplistic example of the option to expand, which might color how you think about the DCF value for your company. So think about what you've done right now. Yeah? You've taken the expected cash flows based on the business or businesses you think your company is going to be in, discounted in the back at a risk-adjusted discount rate to come up with the value. Say I did this for a company that produces security software. And I come up with $115 million as the value of the company. And then I throw in a wild card. I said, this company is selling its software to clients and it's collecting data from these clients about threats to their system. I have the proprietary data on these threats. Somewhere in the next 5 years, I can take that data and create a second business. Let's call it the database business. Seems like a reach, right? And I give you some numbers. I say, if I did that today, the cash flows I will get from doing it are going to be $40 million a year for the next 10 years. But it's going to cost me $500 million to do it. Even without doing time value of money, you can see this doesn't look good, right? You spend $500,000 and you get 40 million every year for 10 years. Even without discounting, you're already underwater, right? And this is a risky business. You think, who cares? And many of you have companies where there are other things they could do. You look and say, no, it's not going to work. I'm going to give you a hook that you might use to argue for a premium on your DCF. In this case, I'm going to treat that the second business as an option. What are the characteristics of the option? If I took the present value of 40 million a year at the 12% cost of capital, I get 226 million. That's well below the $500 million that I have to invest. It's a negative net present value of minus 274 million. But here's the saving grace. That second business is incredibly risky. And normally that would be a bad thing, right? But here's a good thing. I haven't made the investment yet. If I throw in that high risk, 50% standard deviation, the value that I get for that second business, that option to expand as an option, is 56 million. A project with a negative net present value of minus 226 million, a really risky business, has huge option value because you're uncertain. Again, if you think about the implications, you can see why companies enter into risky big businesses and are okay with losing money because there's really incredible option out there. So when you look at the option to expand, that becomes the driving factor. But here are some questions to ask whenever you hear this argument being made. It'll be made as a strategic expansion, a real option argument. First question you got to ask is, do I have to take the first investment to get to the second one? Because if I can unbundle the two, why are you forcing me to take that first project, which is bad? Second, assuming I have to take the first investment to get to the second one, how much exclusivity is there on the second investment? That software company, that's a question you need to ask them. You're collecting data, but what is unique about the data? What is exclusive about the data? And I have a piece on big data where I argue that most big data is worthless. Why? Because everybody has it. What kind of data? Your location data. If you get a chance, check your smartphone. Check how many apps know your location. I checked, I think a couple of weeks ago, 27 apps know where I am at every point in the day. I really don't care. But if they tried to tell me I have data on you, my response is so do 26 other apps. My apps all know where I am more than my spouse does. But it doesn't make any difference. There's nothing exclusive. Data to have value has to be exclusive. And that's the question that's going to drive whether you attach a high value or low value to this option. So if you were to pass the option to expand through the test, let's go through them. Is there an option here? Yes. The underlying asset is that expansion you hope to make in the future. The contingency is the value of the cash flows exceeds the cost of expanding. You will take the project. If not, you won't. Is there exclusivity? Varies, right? So when a company says we can do other stuff, the question I'm going to ask is where is the exclusivity? It's become a big argument when you value platform companies. You know what I mean by platform companies? Facebook, Twitter. Is there a value to having a lot of people on your platform? Yes. Could you do other stuff? Maybe. But I think Facebook is in a better position to do it than Twitter is because people on its app are stickier, you have more people. So the questions you would ask in attaching that option will vary depending on whether you have exclusivity and how strong it is. And thirdly, when I use an option pricing model, as I just did in the last page to value that option, I'm really stretching the limits of option pricing. The option is not traded, the underlying asset is not traded. I'm just making up stuff as I go along on variance. And so you're really pushing the limits, but that doesn't mean that you won't use the logic. What I want you to take out of real options is not the Black-Scholes application, but the mindset that comes with it. 7 years ago, remember Facebook had the Cambridge Analytica scandal? Its stock price dropped. Now, I'd never owned Facebook till then. Actually, let me take it back. 2012, right after their IPO, I owned them for a brief period. But 2017, when the stock price dropped, I valued Facebook, and I got a value roughly equal to the stock price. And I bought the company. People said, why are you buying the company? It's fairly valued. And I said, I'm valuing it as an online advertising company, but I'm not factoring in the reality there are billions of people on their platform that they could do other stuff with. Right now, it might not be viable, but there is optionality there. Many of your companies might be close to fairly valued. And as you make that decision as to whether to buy the company, one of the questions to ask is there some optionality here? I mean, I know people are valuing Peloton. Is there any optionality there? Maybe we stretch the definition of exclusivity, right? You have a special subset of people on your platform. But to the degree that there's exclusivity, you can argue that many of these platform companies, you're paying more than just the DCF value because you're getting that additional premium. So I'm going to pause there. When we start back up on Monday, we're going to talk about the option to abandon and then talk about how distressed equity in companies take on the features of NOM. Yes.
So in the beginning of class, you mentioned there are 6 variables that dictate an option's value. There's the value of the underlying asset, value, the variance in the value. So that's the vega, right?
No, that's the sigma.
Oh, the sigma. Okay. There's the interest rates.
Mm-hmm.
And then what were the other 3? Do you list them?
Strike price in the life of the option.
Huh?
And then the dividends on the stock.
Okay.
Right?
Okay.
So the dividend yield, the Y in the model. Which model are you looking at?
I put this up. So wait, this is sigma because
That's sigma. That's not right. That's sigma. That's the S in the model.
S. Okay.
Strike price is the K.
Okay.
Interest rates are the R in the model. Life is the T in the model.
Yep.
The dividends are the Y in the model.
Okay. Thank you.
I think that option value is a way to value, very young companies like startups,
There's
because
some there's some optionality, right? But the question is are you just valuing, don't mistake opportunities for options. So young companies, you have a big market, you can say that cash flows can potentially go out. That's why I'm paying a large amount. The optionality comes in only if you believe that if the company succeeds in one business, it can do other businesses as well. Right now, you don't know what those businesses are.
It just,
Yeah.
was this, like that many more companies now, like reach IPO before they turn profitable, that, and like, even when you talk to VCs and pre-IPO, a lot of the attention is addressable market. So the
That's not
upside, and it's
necessarily option,
track-
right?
and it's-
Addressable market can also show up in potential revenue growth. So if you have a big addressable market and I do the valuation of your company, I can potentially give you 50% revenue growth because you're going after a $2 trillion market. So I'm going to reward you in your DCF with a higher revenue growth because you have a bigger total addressable market. Optionality actually comes from beyond it. If you reach this addressable market and you're very successful, are there other markets you can go after? So in the case of Facebook, the addressable market is the online advertising market, which is about $1 trillion, which is a pretty big market. But the bigger question with Facebook is, let's say you become a large part of that online advertising market. Will that
Telegram right now.
exactly? Which is, the question is, now that you have a large portion of that addressable market, are there other things you can do that you would not have been able to do if you weren't successful in the advertising market? That's the optionality. It's something you can't see right now, but you think that success in the market they're in will allow them. Let's take DoorDash, right? Let's suppose you believe it's going to become a successful online food delivery business. So you take the potential market, you come up with the market. And then you say, if they succeed in that market and become 45%,
Maybe
could
pharmacy
they
delivery.
own the restaurants themselves, right? Could they go out and become something they can't do now because they now control the market, right? So that's the optionalities. You can't quite name it, but you think that they're going to get an advantage in other spaces, which you can't put into evaluation right now because it's not viable. But it could become viable if they succeed on that first investment that you see them succeeding in.
And so basically, but then before we would, use probability basically to estimate that. So basically, we
But
go from
the problem here
probability
is
to
right
just
now, it's
worry.
not viable, right? So even if you put a probability, it's not going to add to the value of your company. It's contingent on something happening, and then it becomes viable, right? So right now, if you did an expected value, you won't give much expected value to those new businesses because they're not viable. What's different about options is if you succeed in the initial business, the viability of those other businesses could shift. And that you can't capture in a DCF, right? That's optionality. That's pure premium coming from the uncertainty of the businesses you're in. That's what the real options component brings in. And that's why you can't bring it in through traditional cash flows and discount rate. It's not because you're not being forward looking, but today, when you do the cash flows and discount rates in those new businesses, they're not viable. They're not good businesses. But you're saying there is optionality there. They could become good businesses. So right now, I don't think Facebook can make money doing entertainment with their 3 billion. Right? But could that change? Maybe they will acquire TikTok and make it part of Facebook, and then it becomes this viable second business. And that second business could have value, but it doesn't have value right now.
Hey, how you doing,
Hey,
sir?
how are you?
Professor, we spoke to you after that quiz about the group situation, and
Do you want to do as a group of two?
we were
Yeah.
thinking about like if that's an option at this point.
You'll have a limit of 8 pages then, 2 companies.
Eight pages.
Okay.
All right.
Also, for my DCF, you emailed me feedback. I'm Michael Rankbone.
Hmm.
I messed, so yeah, I did not realize I had to do that page. So on the front page, I did all of that. I
Yeah,
think
put
that
it-
was all,
just transfer it into that story
Okay.
page so I can see what's
because
going on.
I didn't understand, so at first I didn't understand what the email said, because it was like. I
That's
think-
why I sent you the picture. of
Yeah,
the story.
then it made sense. Like,
I look
it's
at
like-
that and I said, no, I see the numbers, but I
Yeah.
don't see how the story connects to the
Okay,
numbers. So
sure.
that's what,
I just didn't know,
Yeah.
I didn't get that
Okay.
far. I
That's-
appreciate
just
your feedback.
transfer what you have on that front page into the story
Yep.
page. Because that's what you're going to be turning in with your final
Yes.
project, is just the story page.
Okay.
Right? Because I don't want an extensive write-up. So essentially, you're going to give a very short lead into your DCF, take a picture of your story page, attach it in there.
Sure,
No.
no worries.
I also didn't get feedback. I don't know if you're still working on it or it's just
There's
something.
nothing I'm working on, so send me another email. So I
Okay.
don't know where it's
Oh,
going.
okay.
Sure.
Yeah, 'cause-
Thank-
all right.
Thank you so much, Professor.
Thank you.
Mhm.
Appreciate it.
Take care.
I had a question on if you value a real option which has like semi-exclusivity, like a solid brand value.
It'll be, so you value the option, then you take a portion of that value, right? So think of it as 0-1. You have no exclusivity, you have complete exclusivity. The option value that you get from an option pricing model is complete exclusivity. 0 is no exclusivity. So you're saying where in that spectrum between 0 and 1 is my exclusivity, right?
And how do you kind of calculate that
Well,
coefficient?
I think it depends on what the exclusivity is in the first place, right?
Okay,
I mean, where does it come from?
okay,
Right? Which, as I said, if you have licensing or a right that emerges, then you're closer to complete exclusivity. I was the first mover, you're very weak exclusivity. So you got to tell me what you think the advantage you're getting from being in that game first.
okay. So if you could kind of argue that there's like a lot of businesses that could have a first mover like impact.
It's
without
very
having-
weak. It's a very, the added option value there, I wouldn't even
Minimal.
bother, right? So if their point is, we were there first, fine. So what, right? Others will observe what you do. They'll just copy you, right?
Okay.
So unless you can say we were there first and let me give you an example. You're an electric car company. What is the advantage of being there first give you? You said the charger technology. You are the ones who can. So you could argue that every subsequent player has to play by your rules
Okay,
because you already set this, right? Because otherwise, they're already charging stations set up. So everybody else now has to kind of bend, which is one of the problems if you're an electric car company in the US, because Tesla has set. But the reason BYD has been able to come up with its own 5-minute technology, charging technologies wasn't as clearly established there. They were able to kind of break away from the Tesla model.
okay,
So lots of ways in which, because that's every company, that's what they try to do. They try to create stickiness in the model, exclusivity. And the question you're asking is, what are you doing and how big of a barrier to entry can you create with what you're doing?
okay. And I guess if you were trying to create or find the coefficient for like the significance of
It's
exclusivity.
low or high, so not even putting a number. If it's
Okay.
high, then count the option value. If it's low, don't count it at all and just leave it at that.
Oh, okay, okay, makes sense. Thank you.
Hey,
Professor,
Right.
I just had three questions. So
Mhm.
one of them was reconciling. So how is with the dividend yield being the cost of delay and cash flows as a percentage of value, that makes sense.
Mhm.
But relating that to 1/n.
Well, if you have 17 years of protection, you wait a year.
Is
What do you
that
lose?
is that like a time? Is that like a
One
time
16th of, so basically it's a very, so if you have nothing else to go on, you just say, I've lost 1 out of the 17 years. My cash flows are uniform across time. That's 1/17 of my excess cash flows gone because I didn't exploit it earlier.
Okay.
You'd
so
rather use cash flows if you have it, but if you don't have it, you're kind of stuck with this 1/n.
right.
It's kind of your best estimate of how much you give up.
Okay, that makes sense.
Yeah.
And then the second question was, when with most options or like patents or
Mhm.
like you're mentioning U.S. government auctions off like
Mhm,
pieces of land
reserves.
for the reserves. Is there a circularity problem there with including the cost of the option into the cost of developing the reserve? I mean,
But circularity in what sense, though?
so the cost of
The cost
developing
of getting
reserve-
the option is nothing to do with the cost of developing. They're two separate issues, right? When you
Right.
go bid with the US government, you're not getting, all you're getting is 15 years of rights to develop. There's nothing you're doing to develop the reserves. You're getting 15 years the right to develop those reserves. So when you walk out of that room, having won the auction, all that's changed is you now have the right to develop these reserves in the Alaskas, whatever.
Mm,
Right? You still face the choice of whether to develop the reserves or not. If you do nothing for the next 15 years, you don't
Right.
spend any additional money. At the end of the 15 years, you throw your option away and you say, I wish I hadn't paid that 250 million up front. If you choose to develop the reserves, now your job begins. You got to send the rigs out, you got to put them up. That's that K in the model. It's
Right.
not inclusive. The original cost has already been spent, right? It's sunk. This is the additional cost you got to spend to actually develop the reserve and make it an oil producing.
Right,
Is-
okay, that makes sense. And then the last question was on quiz 3.
Mhm.
So the first question for quiz 3, it goes on a consistent EV to EBITDA basis, which company is cheaper? So when I was doing the question, what I ended up doing was because I wasn't sure what cheaper meant, I took
But it said EV to EBITDA, right?
EV
So,
to EBITDA,
yeah.
yeah.
So lower EV to EBITDA would be cheaper. So the
Right,
question,
yeah.
yeah.
And if you account for minority interest and minority holdings, you end
That's
up
a
with the same.
consistency issue, right? What is
Right.
it's consolidated, it's EV. So consistency basically leaves you with one path, right? You got to add the minority interest, subtract the minority holding,
Right.
because otherwise it's not consistent.
Right, exactly.
Yeah.
That but I went a step further of that
Mhm.
and I compared it to what it was currently trading at. So if you hadn't accounted for minority interest in
But
minority
that's what the
holdings.
the EV to EBITDA is what it's currently trading at. So do you scale it to something different?
I took a I took a version of EV before you factor in minority interest and holdings, and after you factor in minority interest and holdings,
Okay.
and then
But still, you'd have to make it into a multiple of some sort to compare the two companies, right?
right.
Because you have no dollar values in either company,
right,
right?
exactly. I guess in that case, what I took cheaper to mean would have been what the company was trading at relative to what its correct value would have
But
been.
you're comparing to the other multiple then, right? Ultimately, there has to be a comparison. Cheaper means you've got to compare the two companies.
Right.
So cheaper, what did you compare it to say it was cheaper?
I actually have.
Yeah.
So this is what I ended up doing. So with the giant question marks. I had a version where I took EV to EBITDA on like a pure basis after you factored out minority interest and holdings. And then I took a version of it for what it was trading at. So that was before.
That's what
you
I'm, that's
account
what
for
I'm
it.
confused. What do you mean trading at, right?
Right.
So
So I
it's
assumed-
trading at 800 plus. So basically, this is what it's trading at. Do you have a different version of what it's trading at? Because this is a traded value, right? So you're saying you didn't count any of the cross holdings?
Oh, so 1250 would have been a value after you've subtracted minority holdings and included minority interest.
But why am I doing that? Because I want to make sure that I'm comparing two companies and I'm comparing apples to apples, right? That's the only reason I'm doing it. It's not a standalone number. I mean, all of pricing is comparing to something else.
Right.
And what you're trying to do is make sure you're being consistent in that comparison, right?
So that correction is about
Exactly, to make sure that the two, so let's say one of these companies had no cross holdings at all and the other did,
right.
right?
then-
If I did not do this, I would find one of the companies to be cheap for all the wrong reasons. Not because it's cheap, but because I didn't factor in. No.
Exactly.
So
They had
So
consolidated.
when you do, so what's a 50? So basically you went back to just this number and this number, 1200 and 1700.
Yeah, and then I
But what's
compared
in
it
the
to
denominator?
it's still EBITDA, but I
there's a-
compared
But
it to
there's a
itself.
consistency problem, right? The
Right.
250 is EBITDA, it's consolidated EBITDA. It includes 100% of the EBITDA
That makes sense.
of the subsidiary, and your numerator includes only the 60% in the
Right,
market
then
cap, right?
you-
So the
yeah.
problem is this multiple internally would be inconsistent, which means that I'm not sure what I'd be comparing when I compare across the two numbers, right?
That makes sense.
And so I'm glad you showed the first one. Otherwise, you'd have lost points if you showed that as your final answer. So,
Yeah. All right.
Okay.
Professor. Thanks again for the book.
You're welcome.